In this video, I'm going to talk about my investing plan for 2026 and the things I'm seeing in the market. There are three markets I predominantly look at: the US, Australia, and New Zealand. These are the most accessible exchanges with the brokers on offer in this part of the world. I'm going to cover the strategy I follow, the macro trends I'm seeing, and how I plan to pivot in 2026. To caveat early in the video, I'm not an aggressive investor. Now, I was earlier in my journey, but today I've learned my lessons. So what I talk about today fits my situation, but yours might be different. Today's video is brought to you by InvestingPro, a fantastic tool I use almost daily to find investment ideas, analyze stocks, and leverage AI to research investments easier and faster. But we'll talk more about them later in this video. So first, what investment strategy do I follow? I quite like the core satellite one. If you're new to it, it's a simple but powerful strategy with two groups of investments: cores and satellites. Most of my money goes into safe, broad, long-term investments that form what's called the core. A smaller portion goes into higher risk, more exciting investments called satellites. Now, the core gives your portfolio stability, and the satellites give you room to take more small, controlled bets. A good analogy is making a smoothie. The fruit and yogurt are the reliable base that makes up most of the drink, while the toppings like honey or chocolate chips are small extras that add flavor. Even if the toppings don't work out, the smoothie will still taste good because the base is strong. I try to hit the Pareto principle with 80% or so of my money going into the core and 20% into the satellites. Now, overarching the core satellite strategy, I also employ dollar cost averaging. So when I'm paid, I have an automatic payment to my brokerage accounts and they automatically invest for me. It's quick, it's easy, and it's convenient. To simply get exposure to a broad diversified core is through funds, as they bundle hundreds or even thousands of stocks in a single investment. It's often cheaper as well, as we just have a single transaction fee. So large ETF and fund issuers like Vanguard and even Kernel here in New Zealand have a lot of information online that talk about the strategy. To find satellites, I use tools like InvestingPro, Stockopedia, or just macro trends to identify pockets of opportunity. Maybe they go up, maybe they don't. That's why they make up just around 20% of my portfolio. I have a strong portfolio base, but I have the ability to take measured risk too when an opportunity arises. Now, we all know investing.com. I want to take a quick moment to talk about their flagship product, InvestingPro. It's a handy tool that helps me with my stock research. When I'm out of ideas, ProPicks is a great tool that saves me a lot of time. Using AI, they scan the market to build winning portfolios, including these four Australian ones. While the ASX is trading flat for the year, ProPicks are up over 30%. Now, once I have a few ideas, I jump over into the Warren AI tool, sitting alongside ProPicks. Basically, it's ChatGPT for investing, and I can ask it to research stocks or industries that I'm interested in. It's loaded with all of the latest news and financial data, so you're talking to the latest information. If I ask it to provide an overview for Woodside Energy, I get the latest news, analyst ratings, financials, stock data, all of this in just seconds. The Screener tool is another option if I want to narrow down the thousands of stocks and ETFs on offer in Australia and abroad. Investing.com is currently running their Cyber Monday sale for a limited time only, plus subscribers of my channel get an extra 15% off. This offer is only available for a short time, so make sure to check out my link down below in the video description or scan the QR code to get started today. So the core satellite strategy is the one that I use and guides how I invest. And on top of that, dollar cost averaging allows me to do this automatically every time I'm paid without fail. No matter what the market's doing, I'm always investing. When the market's up, I buy less units, but when the market goes down, I buy more. Now let's talk about how I plan to execute my investments in 2026. Here is what my portfolio currently looks like as of November 2025. Of the invested capital, 86% of my portfolio is made up of the core and 14% the satellites. Back in 2020, it was roughly 50-50, as I was more gutsy back then. Today, I'm a lot busier. I've already managed to buy a house, etc., so I don't want to spend too much time chasing a positive alpha. Later, I'll talk about the macro trends that explain why I have over 50% in cash. To start, let's talk about the core. I live in New Zealand, so to build my core, I predominantly use Kernel. Today, they manage over $3 billion, have over 40,000 Kiwi investors, and have some of the lowest fees in the market at 0.25%. This year, I switched my KiwiSaver from Milford to Kernel as their funds have underperformed for a few years now, and their fees are relatively high. So I'll be closely monitoring this in 2026. Kernel offer funds rather than ETFs as they're sold through their website and not a stock exchange. The advantage there is A, I don't have to exchange currency, and B, there are no transaction fees like I would get with an ETF through a broker. Now, if you did want to go down the ETF path, Smart is a great option, offering over 40 ETFs, and they can be found through the likes of InvestNow and Sharesies. They even have a core series, which is a great place to look if you're building your core for the core satellite strategy. US shares, Aussie shares, Kiwi shares, global shares, bonds, cash, they have most bases covered. In my chart, they're the small 1% Sharesies portion. So Kernel and Smart are two great options when it comes to building a core. Beyond stocks, gold is another popular option when building out your core. You can buy it physically through an ETF like GLD, or what I use is Goldie. In my chart, you can see that I have 6.5% of my investments with them. What they do is they buy a big block of gold, divide its weight by 10,000, and sell those 10,000 pieces to investors. The gold is stored in a vault down in Wellington. They've been around since 2023 and today have over 15,000 users, including me. So my core is invested with Kernel and Goldie, and to a lesser degree Sharesies for buying smart ETFs. If you are based in Australia, you're fortunate to have the likes of Vanguard, BetaShares, iShares and the like. These providers offer their funds in AUD, pay franking credits to offset your dividend tax obligations, and are global fund managers with trillions under management. Brokers like Moomoo make it easy to invest in these funds, or often you can invest directly through their websites. For Kiwis, Smart are the only local ETF issuer denominated in New Zealand dollar. The reason that I only invest my core through onshore options like Sharesies and Kernel is that A, I don't pay currency conversion fees. B, I get the benefit of Pi tax structure, capping my tax rate to 28% on investments. C, it avoids fifth tax obligations. And finally D, the options we have now are actually pretty good. Moving along, we have our satellites. My largest of these is Bitcoin and Ethereum through eToro, followed by Sharesies and Moomoo, which I use for my individual stock investments. Starting with the crypto, the value of this has of course risen over several years. I own a Ledger Nano. I've also used Binance in the past, but eToro just makes it easy. Now I know it's not the best practice to keep money on a hot wallet, but I shifted my funds from Binance about a year back. I get scam calls at least once a month from a fake Binance number, so at some point I assume my details got leaked and hackers knew I had money with them. So I got uneasy and I like the eToro platform. This is 100% a speculative investment for me, and keeping it around the 2% mark is where I feel most comfortable. Maybe it goes up, maybe it doesn't, but that's why it's part of my satellite collection. Sharesies has been my broker since 2019 when I first moved back to New Zealand from Singapore. Since then, I've kept money with them, paid almost $1,000 in fees, and built the account up to $80,000–$90,000 before buying my house back in 2022. With the current fee structure at 1.9%, I'm less willing to use them these days, but for local New Zealand investments, they're one of the only options. If I were a beginner though, their app is super easy to use, so it can help you get started. Their plans come in cheaper, and they also encourage best practice through setting up auto-invests and investment goals, so it might work better for some. So with Sharesies, I have around 3% invested into individual stocks in New Zealand, Australia, and the US, as well as thematic funds. Moving along, we have Moomoo, which entered the New Zealand market earlier this year. It's easily the most comprehensive investing app that I've seen, with lots of tools and data to inform your investing. In 2025, they are Australia's most downloaded trading app with access to the US, Aussie, and Hong Kong market. I look forward to using them more in 2026. And finally, let's talk about my cash situation. I'm sitting on a lot of cash as I feel uncomfortable investing large sums in the current market. I reinvest all of my dividends by default, so this is money I'm stockpiling on the side that otherwise would have been invested. So let's talk about the macro trends I'm seeing for 2026. Firstly, interest rates. Against my property, I have an offset account. This means that cash savings offset my mortgage balance, effectively saving me from paying interest on that portion of my mortgage. Mortgage rates have been as high as 7.35% in recent years, so keeping cash on the sidelines, effectively earning 7.35% risk-free, was my preferred option. I've also done a lot of traveling, getting married, All these things that cost 5-figure sums, so having my cash easily accessible for me is important. But that only explains a small tranche of the cash that I have on hand, and now that rates are well down, my reasoning has changed. Second, Warren Buffett is sitting on a pile of cash himself. His company, Berkshire, currently has over $380 billion sitting in cash and treasuries. And to top it off, he isn't even doing stock buybacks right now, which is a sign that he doesn't see his stock as being good value. Now, Warren isn't a market timer, but he is price sensitive. If the world's most famous value investor can't find attractive deals and is happy to sit on cash, then I figured that's a strong indicator of where we're sitting. In 2026, I'll be watching for opportunities to make lump sum investments once we return to more reasonable valuations. Following on from that, everything has recently hit all-time highs, so the margin of safety is thinner. The New Zealand exchange, all-time high. Australia's ASX, near all-time highs. The S&P 500, also all-time highs. Gold and silver, all-time highs. Bitcoin, a month or two back, were at all-time highs as well. Right now, I continue to dollar cost average into my core funds in all three markets, but the lump sums, they'll have to wait. Here is a chart showing the price-earnings ratio of the S&P 500 over the past 20 years. Basically, this is the price people are willing to pay for every dollar of earnings. The levels we're currently at are the highest for a non-recessionary time. The spikes in 2021, 2009, and 2020 followed US recessions. So with where we are now, things are looking very frothy. Tech stocks have gained on the back of AI hype, significantly outperforming other sectors. Now, AI is great, don't get me wrong, but leading institutes are starting to question whether corporates are seeing the profit and productivity gains that the market is betting on. Following that, the weak New Zealand dollar. Against the AUD, we're sitting at 88 cents, the USD 57 cents, and don't even get me started on the Singapore dollar. There are two sides to a weak dollar. First, it's great for domestic exporters, but second, it's bad for offshore direct investments. I made a video a couple weeks back looking at the outperformers on the NZX this year. New Zealand exporters featured strongly, and they're benefiting from the lower dollar. Local investors earning in New Zealand dollar, however, are struggling. When we invest in Australia or the US, we need to convert our money into AUD or USD. The Reserve Bank here in New Zealand has started to suggest the OCR might not fall further. So there's a good chance we've seen the bottom. So if the dollar rises from here as other countries continue to debate rate cuts, our effective returns on foreign investments could be offset by currency losses. So in 2026, I'll be looking for a rotation back into New Zealand stocks. Positive economic data, household and business spending on the back of low interest rates and other such indicators will indicate whether we'll run or crawl out of our current economic doldrums. For all the talk of the economy being fried and everyone heading to Australia, the stock market has quietly climbed back up to all-time highs. This shows that many investors in the New Zealand market believe the future is brighter than the present. So these are a few things that I'll be looking at to guide my investing in 2026. I'm sitting predominantly in cash, watching the market, looking for positive macro data, and have some renewed interest in the New Zealand market. If you have any other thoughts for 2026, please let me know down below in the comments and we'll have a chat there. If you want to give InvestingPro a try, make sure to sign up using my link down below. They're currently running their Cyber Monday sale, plus we've managed to get an extra 15% off for my YouTube subscribers. So click the link down below in the video description or scan the QR code to sign up today. If you like this video and want to see more investing content just like it, make sure to subscribe to my channel down below. Also check out these videos over here, which continue the conversation. Thanks for watching and I look forward to catching you on the next one. Cheers.